The inflation number they report isn't real. A new report shows inflation at 3.4%, and it's the only number the Federal Reserve truly cares about. This single number is the trigger that makes your mortgage, car loan, and credit card debt more expensive. But the real reason the Fed uses this obscure metric, and not the one you see on the news, is a carefully guarded secret of the financial system. By the end of this video, you'll understand the hidden logic that drives their decisions and what it signals for your money. It all starts with one data point: Core PCE. The headlines are everywhere. Core PCE inflation rises to 3.4%. On the surface, the story is simple. Inflation is proving stubborn. It's not falling as fast as the government wants, so the Federal Reserve will likely raise interest rates again to cool the economy. For you, that means borrowing money is about to get more expensive. Your plans to buy a house, a car, or even just carry a balance on your credit card are all about to be repriced higher by the central bank. The mainstream story ends there. But this is where our story begins. Because you've been hearing for a year about the CPI, the Consumer Price Index. So why, at the most critical moment, does the Fed suddenly pivot to this other number you've barely heard of? The answer reveals the first layer of how the system really works. There are two different versions of inflation, and the government chooses which one to use. The first is the one you know, the CPI, or Consumer Price Index. It measures the price of a fixed basket of goods and services, things like a gallon of gas, a loaf of bread, a dozen eggs. It's designed to measure your cost of living. But the Fed doesn't use it for their most important decisions. Instead, they use the PCE, Personal Consumption Expenditures. The PCE is different. Instead of a fixed basket, it's flexible. It assumes that when the price of steak goes up, you don't just pay more for steak, you substitute and buy more chicken instead. The Fed claims this gives a more accurate picture of inflation. But here's the catch. PCE almost always shows a lower rate of inflation than CPI. It measures how you adapt to higher prices, effectively masking the initial price shock to your budget. It's a subtle but critical difference. They're not measuring what things cost, they're measuring what we spend after we've already been forced to change our behavior. But it gets deeper. The number that just hit 3.4% wasn't even the full PCE. It was Core PCE. Core is the Fed's code for excluding food and energy. Their official reason? Food and gas prices are too volatile and distort the underlying inflation trend. But think about what that means. The two things you absolutely cannot avoid buying, food to eat and fuel for your car, are deliberately removed from the equation. They are measuring the stability of the financial system, not the stability of your household budget. It's a sanitized version of the economy. So when the Fed sees Core PCE at 3.4%, they see a statistical problem that needs fixing. They don't see your $5 gas or your doubled grocery bill. And their fix is a sledgehammer, raising interest rates to slow the entire economy down. Their goal is to reduce demand, which is a clinical way of saying they want fewer people buying things and fewer companies hiring people. They will risk your job to bring their preferred statistic back down to their 2% target. So, what do? This isn't just theory, it's a direct signal for your finances. First, your debt. Any variable rate debt you hold, like credit cards or a home equity line of credit, will see its interest rate jump almost immediately after a Fed hike. If you are planning a major purchase that requires a loan, like a car or a home, locking in a fixed rate sooner rather than later could save you thousands. Second, your job. When the Fed cools the economy, hiring slows down. Companies become more cautious. This doesn't mean a recession is guaranteed, but the job market will get tighter. It's a time to focus on being valuable in your role and shoring up your emergency savings. Third, your investments. Markets hate uncertainty and rate hikes. In the short term, expect volatility. Higher rates make safer government bonds more attractive, which can pull money out of the stock market, especially from high-growth tech stocks. For long-term investors, this can be an opportunity to buy quality assets at a discount. But for those near retirement, it's a time for caution. You are seeing the system's programming in real time. The Fed's mandate is to protect the system. By understanding the data they use, you can anticipate their moves and protect yourself. So that 3.4% core PCE number isn't just a headline. It's the official justification for a deliberate economic slowdown, using a measurement that sanitizes your real-world costs. The Fed's rate hikes are a blunt instrument aimed at a statistical target, and your wallet is in the impact zone. If this helped you see the system more clearly, subscribe to Decoded Money. We don't just report the financial news, we show you the code running underneath it. Next time, we're going behind the curtain of the too-big-to-fail banks to see if anything has actually changed since 2008. The answer will surprise you. Now you see how the money really moves. Money decoded.